When we think about fixed income markets, it's important to think about the entirety of the yield curve. So at the very front end of the yield curve, if the Fed is not cutting as much as expected, you would likely see upward pressure on things like the 2-year yield because you're not pricing in as many Fed cuts. Then if we move out further and think about the 10-year, further out the yield curve, if we have things like sticky inflation, which would be keeping the Fed from being able to cut, we certainly would see upward pressure on those yields because of that stickiness in inflation. Then the big question is, what's the growth backdrop and what does the Fed prioritize? Because if you're in an environment where you're having inflation remain sticky, but the unemployment rate is moving up rapidly, then the Fed is likely cutting in that environment. So all of the response of the bond market really depends on the context of what's going on within the economy, not just on the inflation side, but on the employment side as well.